you don't make your product in America, however, under the Trump administration, you will pay a tariff, and in some cases, a rather large one. Other countries have used tariffs against us for decades, and now it's our turn to start using them against those other countries. This is happening by friend and foe. This system is not fair to the United States and never was, and so on April 2nd, I wanted to make it April 1st, but I didn't want to be accused of April Fool's Day. That's not, just one day cost us a lot of money. But we're going to do it in April. I'm a very superstitious person. April 2nd, reciprocal tariffs kick in. And whatever they tariff us, other countries, we will tariff them. That's reciprocal, back and forth. Whatever they tax us, we will tax them.
This is CNN Breaking News.
Now we begin with the breaking news from Wall Street. Trading has been underway now for just about 30 minutes, and nervous investors, very nervous investors, are weighing in on President Trump's historic new global tariffs. The early assessment, deep concerns.
President, when you look at the market selling off, that didn't concern you? And
Nope,
where do you see it going?
doesn't concern me.
In the stock market this week, worst week for the market in 2 years. Does that worry you, Mr. Secretary?
Not at all. I've been in the investment business for 35 years, and I can tell you that corrections are healthy, they're normal.
I gave a speech yesterday to 1,400 small and community bankers, and they were so happy to hear from your administration. And I told them Wall Street's done great for the past 4 years, 10 years, 20 years. It can continue doing great, but it's Main Street's turn now.
The bond markets finally blew the whistle on Donald Trump's game of chicken with the stock markets. And trouble still in the bond markets. They've played a big role here. Investors started dumping bonds at the start of the week, causing yields or government borrowing costs to soar. It was the highest three-day climb since the pandemic. The pressure on Donald Trump became unsurmountable.
We start tonight with stocks surging as President Trump announces a 90-day pause on some tariffs. I'm Dave Wagner in for Courtney.
And I'm Frank Wiley. That pause impacting the new tariffs that went into effect at midnight, except for those imposed on China. Today's closing market numbers showing the economic reaction. The NASDAQ, Dow Jones, and S&P 500 all showing major boosts after days of decline. The S&P seeing one of its biggest gains since World War II.
I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. China wants to make a deal. They just don't know how quite to go about it.
Now to President Trump's trade war, China retaliating, adding 125% tariffs to U.S. goods. The surcharge going into effect overnight.
如果美方置两国和国际社会的利益于不顾，执意打关税战、贸易战，中方必将奉陪到底。
Closing bells on this Thursday. You're looking at declines for the S&P coming in around 3.5%, the NASDAQ around 4.5%, the Dow up 2.5%. I should point out, if you take a look at the S&P, the NASDAQ 100, the NASDAQ, the Mag 7, they all fell the most at 1 point today, since the most since 2020.
I think we should stop and talk about bonds today, because something really funky happened in the bond market, which is, so what's been happening since the tariffs were announced is people bought bonds. They went into safe haven bonds, they bet on recession, and yields went down. Guess what started happening yesterday? The opposite. And it wasn't a relief rally, because today stocks sold off and bond yields did a full round trip from pre-Liberation Day. And now we worry, do we have to worry about foreigners selling our bonds?
We saw a huge flight out of the U.S. dollar into other safe havens, one of those being the Swissy. Dollar Swiss saw one of its biggest moves since the Swiss depegged in 2015. A 4% move into the Swiss franc is really starting to pose some questions. Are we fleeing U.S. assets and possibly repatriating them into other currencies? The Swiss was a big mover. Yen was a big mover as well. But take a look. This move is continuing to extend, Tom. The euro up nearly 1% so far in the overnight session as we begin to question whether the dollar is acting as a safe haven and if this is possibly permanent damage to the dollar as a safe haven assets. I want to show you one chart which I thought very surprising is that normally in the past when we see huge bouts of volatility in the FX market, when we see the VIX spiking, it normally goes hand in hand with a surge for dollar assets. We have definitely not seen that in the last week. If anything, we've seen the exact opposite.
Hey, Ike, as the U.S.-China trade war heats up, the Trump administration is exempting smartphones, laptops, and other electronics from its reciprocal tariffs. That's according to a bulletin posted by U.S. Customs Border Protection late Friday night. Now, those exemptions also include solar cells, flat panel TV displays, flash drives, computer processors, memory chips, and semiconductor-based storage devices. So this is some relief for big tech companies like Apple, which relies on China to assemble the iPhone. UBS had estimated that the cost of the new iPhone 16 Pro Max could jump by $950 under the 145% tariffs that Trump has imposed on all goods from China.
And so the president is going to come out with his policies on semiconductors and pharmaceuticals. They're going to be outside the reciprocal tariffs. And he was just making sure everyone understood that all of these products are outside the reciprocal tariffs and they are going to have their own separate way of being considered.
But wait a minute. I'm asking you about the exemption, not about, I mean, the notice that went out Friday night saying that electronics, a wide range of electronics, including smartphones, including components used to make microchips, that these are now exempt from the reciprocal tariffs. Why that move?
Well, remember, those products are going to be part of the semiconductor sectoral tariffs, which are coming.
Fair enough. I hear what you're saying on investigation, but there is currently an exclusion for some of those products.
You want to call it an exclusion, potatoes.
No, it's not.
What it is.
The White House called it an exclusion.
Well, but let's say, let's just.
Who is in charge here?
That if you have rates going up a little bit and inflation is sticky and credit spreads are gapping out, which they're going to, I think you'll see more credit problems than people have seen in a long time.
Are we going to have a recession in the United States?
As I said on Monday in a talk that I gave at the New York Economic Club, I think we're very close, if not in a recession now. What may be...
Of course, I'm talking about a recession. Do you think it is likely that the United States will dip into a recession because of President Trump's tariffs?
I think that right now we are at a decision-making point and very close to a recession. And I'm worried about something worse than a recession.
All right. Today is Sunday, the 13th of April. This is a recap of the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Happy Passover to those who celebrate. And a reminder, we got Easter coming out next week. And that means that Good Friday will be a day off in the stock market, just in case you didn't know. Now, I made the intro of this video as long as I can to explain everything, how the events unfolded throughout the week, because there is a little bit of confusion. It's not really an understandable confusion. It is a byproduct of political biases and being in denial. What are we talking about here, Mav? We're talking about my criticism throughout the week about the administration's approach throughout this trade war. And while I called the move that we've seen midweek when the president decided to back off the reciprocal tariffs and delay them for 90 days and just concentrate on China, I came out and said that this is the art of the cave. But some viewers, of course, disagree, and they say that, Mav, you're too harsh on my beloved president, and that's not acceptable. You need to wait. This is the art of the deal. It's part of the grand master plan. We're going to bring iPhones to be made in the USA, baby, by American robots. We got to take care of our robots. They're people too. So let's set the record straight, folks, here. Was it really the art of the deal or the art of the cave? We dive right into it here with In Focus tonight. Forced to fold. That's what happened, baby. How did China cause the administration to fold? Short answer, by crashing the bond market. How did they do it? We will talk about that in a minute, but again, it's baffling to me because why is it so hard to just say that the president fucked up? Why is that so hard? Why the denial and pretending that this is part of a grandmaster genius plan and flip-flop day after day? Oh, we're adding tariffs. See, we're bringing back jobs to the USA. Then he removes the tariffs and backpedals, and you call it the art of the deal. It sounds so gullible and foolish, to be honest with you. You look at Kyle Bass, for example. He says, oh, the world is closing on Chinese President Xi, and China's going to lose and get destroyed. Why is it so hard to just say the truth? And the truth is we lost this round. Can we come back? Yes, we can. But right now, we lost round number 1 in the trade war. And that should be easy to everybody to see, despite your political biases, which are blinding you right now from seeing the obvious. So when Kyle Bass said that we're closing on China, what happened to the US dollar? He has the picture with Xi holding a dollar and on an island. What happened to the dollar? The dollar crashed. So who won round number 1? Why is that so hard to admit? And it was not really hard to predict, to be honest with you. On April 4th, they said that the countdown for when Trump White House capitulates to a defeat in the trade war has begun. A few days later, we got the capitulation. And why was the White House forced to capitulate? Why did the White House get into a position of weakness? It's everything we've been talking about in this channel, folks. Just because you don't like to hear it, it does not mean that it's not the truth. And I said from the get-go, for example, that when the president backpedaled on the Canada-Mexico tariffs and gave the 90 days exemption because the market went down 1%, that's his lethal mistake, because he exposed his weakness right before the battle even began. And then when you do tariffs, but everything is exempt, as we continue to see more and more exemptions, that's also a sign of weakness. And what countries are going to do is, you know what, let's wait and see. He's going to put the tariffs on. Market is going to go down. Let's see how he's going to react. We don't need to negotiate right now. And furthermore, if you say to me that this is the art of the deal and part of the grand master plan, again, remember what I said, because I don't pull this stuff out of my ass. This is a thorough analysis that happens every day. When I said the extensions of the Canada-Mexico tariffs was a mistake, and it's going to bite him in the ass later on, I wasn't joking. It was part of an analysis. Likewise, when we said that the announcement of the tariffs, with the whole cardboard thing, I said that was rushed. That was not a professional job. Not the formulas, not the calculations of the tariffs, nothing. I don't think even Besant was on it. I think they were waiting for a last-minute reach by China. Oh, China's going to call, or Vietnam is going to call, or the European Union is going to call before the deadline of Liberation Day. But they did not, because they wanted to wait and see, based on the weakness that we projected earlier. So the White House had to scramble and just print something out to say, yes, we did the tariffs. Here it is. We were not joking. Well, it was a joke after all, because, I mean, you look at this. Was this really part of the Grand Master Plan? When we taxed a 10% tariff on the Heard Island in McDonald, which has no population at all except penguins. So is tariffing the penguins is part of the Grand Master Plan? Come on, man. Or was this just a rushed piece of work just to save face since nobody reached before the Liberation Day deadline? And we continue to show more and more weakness and flip-flopping, for example, exemption of smartphones and chips overnight or over the weekend, and going back and forth on that. And then, of course, Trump comes out, says 10% is the tariff floor. We could make some exceptions. Okay, so you're telling everybody that you're flexible and you're not really going to stick to your word here. And if you feel a little bit of pressure you're going to have to capitulate. So why bother even negotiating? So again, when we say that, oh, China lost and we won and this is the art of the deal or whatever, not really. When our dollar crashed and our bonds crashed, maybe what Sun Tzu, the art of war, was applied here. The opportunity of defeating the enemy is provided by the enemy himself. And that opportunity is the moment we showed weakness, raised the Canada-Mexico tariffs, and we gave an exemption and a deadline. So please, folks, before you criticize me and say whatever, that I'm biased, it's amazing, right? A year ago, I've been accused of being biased against Biden, and now I get accused of being biased against Trump. Well, maybe I'm onto something. You ever thought of that? Because when you stick to your political biases, and the reality is right in front of you, and it disagrees with your political bias, if you're going to twist yourself into a pretzel to say that this is the art of the deal or this is a win, you're going to sound like an absolute jackass. Hey, look at this account right here. One of my favorite, by the way, The Real Fly. I think he has pretty good tweets. But this one makes him sound foolish. He says that Trump did not fold. He's pivoting after realizing that his advisors were effing R-word. See, you can say whatever you want, but not that one. YouTube will catch you for it. Now fire Ludnik, Secretary Lunatic, that's the Commerce Secretary, and Navarro. And we're back. Well, that's pathetic, to be honest with you. Oh, the advisors now. Oh, the advisors, right. How about we blame the dog? Maybe the dog ate the homework, the real reciprocal tariffs. So they had to come up with the clownish cardboard of the reciprocal tariffs in the Rose Garden. Now, it is true that we have conflict between certain advisors and personalities in the White House. We'll talk about that in a minute. But again, saying that Trump did not fold, this is out of the deal, and oh, it's just the advisors gave him a bad advice. Come on, man. Does it look like China lost or deterred or coming to negotiate? Because that's considered a win. Kyle Bass and everybody else who's still living in this fantasy that this was the art of the deal. China did not do any of that. China keeps retaliating. Every time we retaliate, they keep retaliating. And now we got 125% tariff on U.S. goods entering China. And they continue to retaliate. Today we got the news that China suspends exports of certain rare earth metals or minerals and magnets to the U.S. that are crucial for the world's car, semiconductor, and aerospace industries. That's retaliation. That's not China cooling off or China surrendering or waving the white flag or coming to the negotiation table. None of that. They continue to retaliate against the dollar and bonds. When you see the so-called safe haven in the dollar and U.S. bonds, when you see them crashing in a market downturn and what is supposed to be an economic crisis right now, what does that say about our stance in the world? Investors are saying that we have no confidence in the United States. We don't think that the dollar is a resource of safety anymore. We don't think that U.S. bonds is a resource of safety anymore. Now, China might be distorting the crash that we see in the dollar and bonds because they're dumping. That's how they're retaliating. So when we talk about forced to fold, we're talking about China dumping bonds, China dumping the U.S. dollar. We talked about this subject in details in the latest video. For the members, go check it out. We talked about losing faith in the bond market. We talked about the traditional layers of defense that at some point include the dollar and U.S. bonds as a resource of safety. More reliable than anything, really. More reliable than gold. But this is not what we see right now. So again, how are we winning? China's crashing the bond market because they keep dumping U.S. bonds, and they keep reducing their holding of U.S. bonds day after day. They keep dumping the U.S. dollar and buying gold instead. So we see the dollar crashing and gold moving higher. China been accumulating more and more gold reserves in preparation of this war. And when they dump the dollar, when they dump our bonds, it hurts our markets and our economy. But you heard what Jamie Dimon said in the intro of the video, that we have credit risk right now because we've increased interest rates suddenly. And we've also introduced a recession in the economy and expectations. The combination of both will lead to credit blow-ups, and China knows that. So they're really squeezing here where it really hurts, twisting the knife. The Chinese been planning for this. The month-to-date inflows in the month of February for gold-backed ETFs in China is the second highest in record. And again, I'm just being reasonable here, folks. I'm just giving you the truth, giving you what actually happened. Whether you like it or not, that's your problem. Now, you might say, okay, man, maybe China won for now because they crashed our dollar and bonds, but we're going to win. We're going to come back. We're going to defeat them in round number 2, whatever, because we're now closing on China with our allies in Europe, in Australia, in Japan, and whatever. Everybody's going to gang up against China, and then we're going to score a win. And this is, by the way, when we talk about the art of the deal, The real art of the deal is Scott Bessent. Because Scott Bessent, we'll talk about this in a minute, he's the one who orchestrated all of this exit and all of this plan of, it was all along just the plan to squeeze China alone. And the rest of the reciprocal tariffs were just for fun. And that's the best that Scott Bessent can do at this point because the damage was severe and the bond market was crashing. And he was not going to assume the responsibility under his watch to see the bond market crashing. It's going to damage his reputation. So he had to come out with a plan and convince the president to come out and fold. That's what really happened. And here's Scott Bessent during the famous day, of course, now. In the morning, before the market even opened, he kind of hinted at the shift that they're about to cook and then convinced everybody that this was all about China at the end of the day. Take a look.
Wednesday, after the president gave his address in the Rose Garden, I was doing media. I was out telling other countries, don't retaliate. And I think what a lot of people are missing here is that the levels that were put out last Wednesday are a ceiling. So if you don't retaliate, that is the ceiling.
But here's the reality, right? We say that we're going to isolate China, and our EU allies are going to collaborate with that against China. Well, guess what actually happens? Here's the piece of news that we got. China and the EU in talks to abolish EU tariffs on Chinese EVs. They're making deals. The Europeans are not happy with how we treated them so far. ECB Council member says the US is killing the world's confidence in the dollar. Thank God Europe created the euro. They don't want to come here anymore. You look at the year-to-year change of visitors to the good old USA. It's collapsing in Austria, in Denmark, in Germany. Got a German friend in LA, been living here for about 8 years or so. He's leaving now because he's not sure that he might get arrested and deported out of this country because of a tweet. You never know. Iceland coming down, Norway, Spain, Sweden, UK, nobody wants to come here. Now, the tourism season is important. It's about to begin. This is supposed to be a golden opportunity because the euro has been rallying against the dollar, which means that European tourists should be coming here. It's in their advantage. And we've seen this phenomenon right before the financial crisis in 2008, 2009, when the euro was higher and there were a ton of Europeans here. They're supposed to come here, but they're not going to come here. And that's a huge loss for the country's economy. Here's another one for you. Danish shoppers boycott U.S. products as Greenland and trade tensions escalate. Don't forget about the Canadians now boycotting U.S. products. So how are we winning? Please go to the comment section and convince me. Maybe I'm missing something here. I'll show you what I'm not missing, though. What I'm not missing is consistency. And you don't bend, you don't waver, you don't twist yourself into a pretzel and change your values and change your opinions just because we have a different administration in the White House. I told you before, I'm not part of the blue or the red cults. I'm part of the Maverick Party. What is the Maverick Party? We got one motto. What's right is right, what's wrong is wrong. That's the end of the story. For example, when it comes to insider trading, is it different if Nancy Pelosi does it or if Scott Bessent does it as somebody knew ahead of time of the upcoming capitulation that we've seen midweek, and they loaded up on call options in the NASDAQ? Looks like an insider trade for me. Then in the White House, Charles Schwab was visiting and Trump said, he made $2.5 billion today. So again, when it comes to the Maverick approach, insider trading is bad. If Nancy does it, it's bad. If Scott Bessent does it, it's bad. We don't say, but it's bad when Pelosi does it, but Scott Bessent, he's a good guy. Come on. When it comes to war, is war good or bad? Well, I'm against war. It doesn't matter if it's the war in Ukraine or the upcoming war in Yemen. Both bad. I'm consistent. What I believe in, I'm consistent in. But some of you, the war in Ukraine was bad. Money laundering, etc. But the upcoming war in Yemen or whatever, Iran, that's good because Trump is doing it. Not in my book, baby. How about increasing the budget deficit? Some of you say, it was bad. You're complaining about it when Biden was doing it, but now that Trump is doing it, it's going to work out later on. It's just, it's for now. It's part of a grand master plan to increase the deficit. No. Regardless who does it, Biden or Trump, that's bad. That's what I believe in. I'm the consistent type. And consistency matters, by the way, because it shows your true value. Do you really believe in something or not? We'll talk about that in a minute. But again, when we talk about the budget deficit, here it is, the March budget deficit, $160.5 billion. The estimate was we're going to cut $145 billion off the deficit. So that's disastrous. Yeah, but wait till you see the results from Doge, Maverick. Well, here's the results from Doge. Elon Musk wanted to cut $2 trillion. Now he says, okay, we're just going to cut $150 billion. And by the way, why do we see the US dollar and bonds crashing like this? It ain't just because China is dumping. The budget deficit has a lot to do with it. And the administration is now planning to increase the budget deficit by introducing the tax cut bill. And I know what you're going to say, but we can cut and all of that. Look at how the cutting that we've done in Doge going so far. It's easier said than done. But we cannot afford, this is the reality. I'd love to have it, but we cannot afford another tax cut bill. That's going to be a fiscal nightmare. Take a look.
So let's just go back to the two budget plans. The House back in February passed its budget plan, and it would have had up to $4.5 trillion of tax cuts. It would have had some spending increases for things like defense. It would have cut a lot of money out of Medicaid, $880 billion potentially out of that sector anyway. And it would have added $2.8 trillion to the deficit over the next 10 years. Then the Senate came along and it passed its version about a week or so ago, and it had $5.3 trillion of tax cuts. It had spending increases for some of the same things, defense and so forth. It had $4 billion, that's $4 billion with a B, of spending reductions, $1 billion each in 4 categories, and it would have added $5.8 trillion to the deficit. What happened yesterday is the House adopted this. So we are now looking at potentially a $5.8 trillion increase in debt over the next 10 years. And to your point, here's where we're headed. We are headed all the way up here. We're now roughly, our debt happens by coincidence to be essentially equal to the size of our economy, but it is going to continue to escalate. This is the Senate one up here, obviously ahead of the other ones. And remember one other important point, Joe, that in addition to this, we have all these liabilities for Social Security and Medicare. And right now, we would need to deposit, in effect, another $73 trillion into those trust funds to pay for those benefits. They're not fully funded. So we have a massive fiscal problem.
So again, folks, when we talk about congruency and consistency, you gotta be careful right now, because a lot of the folks who were bearish last year, for example, because Biden was president, all of a sudden they're bullish now. Oh, the economy is great, the market is going to rocket higher again, and they're cheerleading for the market to go higher. So you don't really believe in anything, you don't have any stance or anything. You're just going to flip-flop based on who's occupying the White House. And it goes the other way, too. A lot of folks were bullish last year. 401ks to the moon, thanks to Biden. And now they're shitting on the economy, they're complaining about inflation all of a sudden, they're complaining about 401ks when they cheer-led for the bubble. And that's just filth to me. This lack of consistency and flip-flopping, fuck them all. You gotta listen to somebody who's consistent and actually stand for something. For example, I appreciate this from Peter Schiff. He says, don't get me wrong. I commend Trump for recognizing his mistake and trying to correct it. It is rare for any government official or central banker to admit to being wrong. But I'm not willing to accept that crashing the stock and bond markets was part of his genius master plan. Amen. You can do both. You can praise him on the border. You can say you voted for him. It doesn't matter. But when he fucks up, he fucked up. There's no other way to look at it. Or put a lipstick on a pig. Here's another good take from Stock Spy 1. He says, I voted for Trump and would do it again against the same opponent. The opponent that nobody elected, by the way, right? There was no primary, right? Maybe that was part of the reason folks didn't vote for her and voted for the other guy. Anyhow, but this tariff fiasco is a complete and total clown show. I don't think he recovers. He damaged himself, even his supporters. Amen. That's what happened. You can admit it. It's okay. Because we didn't win. It was an absolute shit show of flip-flopping, back and forth. What happened is the following, folks. It wasn't the art of the deal. It was the art of the fuck-up. Because right now in the White House, we have two wings. I told you that this is going to happen. At some point, President Trump is going to be head-to-head against Elon Musk. One of these two will last. I think you know who's going to last and who's going to get kicked pretty soon. Just look at the results of Doge. You know who I'm talking about. In any case, we had two sides of the trade war and the tariff policy. You had the Musk wing of the White House and you had the Trump wing of the White House. The Trump wing, of course, you got Pete Navarro. He's a trade hawk. You got Secretary Lunatic, who's, you don't really know where he stands. Maybe he's just an actor. I think he's just acting and saying whatever he needs to say. But I think right now he's in the side of the hawks, the Trump wing of the White House. You got people like Stephen Miller and Bannon. They're all hawks in trade, and they want Trump to go ahead. Even if the stock market goes down, even if the bond market goes down, there's a price to pay, and we have to pay. Again, you can disagree, you can agree, that's up to you, because there is some merit to this argument. But then you have the Musk wing of the White House, and that is Scott Bessent, Kevin Hassett, and some of the oligarchy like Snake Bill Ackman, for example. I mean, he's like a small oligarch. Wannabe oligarch, I should say. But he was crying and bitching and moaning over the weekend that he's going to get a margin call. That's what it's really all about. And he got his wish of avoiding the margin call right now, based on the flip-flopping that President Trump did this week. You got folks like Jamie Dimon. I mean, Jamie Dimon was, from the get-go, saying, hey, we're going to have a recession, and just let Scott Bessent take charge. Take a look.
You know, and then, of course, when they put the tariffs in, it was way beyond what people expected. That will cause a little inflation, slow down growth. But I hope what they really do is let Scott Bessent, who I think is a professional, negotiate. And I know Japan's here, I gather Korea, Vietnam have called, and then eventually Europe. Get those things done quickly. If you want to calm down the markets, show progress in those things, and let Scott take the time.
While Pete Navarro was saying that, hey, the stock market plunge is no big deal. It's part of the medicine. Jamie Dimon and the other wing didn't like that. They think that Pete Navarro is a lunatic. What delivered the win to the Musk wing of the White House was what happened in the bond market, because Pete Navarro can say, hey, the stock market doesn't matter. Maybe it's not. Maybe it's time for us to blow up some of the AI bubble mania, because that's going to be healthy in the long run. And stocks can go up and they can go down. It's okay. But when the bond market begins to experience such volatility, and the bond market is about to crash and create a lot of credit risk in the economy, that's flashing red. You gotta interfere. And I think that Scott Bessent had it. My belief is he was not involved in the cardboard. Knowing Scott Bessent, anybody who worked in Wall Street before knows that Bessent would have never approved of something like this. But he was willing to go with it, so long as it works out. It's part of a negotiation. But when the bond market began crashing, Scott Bessent said, this is not going to happen on my watch. I got a reputation here. If you crash the bond market, you have systemic risk in the economy. I'm not going to assume that responsibility. So he came up with a strategy of, it was all along just isolating China, convinced Trump of a dignified exit from the reciprocal tariffs. And that's what happened. Behind the scenes, that's what happened. Now, the problem is, of course, that the bond market is still crashing. The dollar is still crashing. So here's the other conflict that could happen. If the bond market continues to crash and the dollar continues to crash, that's going to lead to the stock market to continue to plunge and maybe introduce that credit risk for real in the economy. Now, Trump is going to be pissed off at the Musk wing and Bessent specifically of the White House because you made me capitulate. You made me make an ass out of myself in front of everybody just to save the bond market. Why is the bond market crashing, Scott? Maybe we're going to see that kind of conflict. But folks, once again, look, we talk about the political biases and how they blind us. Look no further than the data that we got this Friday, because the bottom line, what really matters, a lot of folks can say, equities will go higher this week. Maybe they are because we have a shortened trading week because of Good Friday. And the bias is going to be for lower volume and more upside and covering and maybe neutralizing some of the positioning before the earnings season. Maybe. But the damage is already done, folks. The damage in the economy is already done. Inflation is going to go higher. It's just a matter of time as these tariffs roll on, exemption or no exemption. And I'll show you some of that in a minute. And likewise, the recession risk is not abating either. It is increasing. So the damage is done. And I think we can play this game of flip-flopping and pumping the market for a day or two. But for consistency, you need to solve the problems of inflation and recession. Look, for example, at inflation expectations that we got from the University of Michigan on Friday, the highest since 1981. U.S. consumers are now expecting an inflation rate of 6.7% in the next 5 to 10 years. That is a disaster. But a lot of folks would say, Mav, the survey is biased because you have a lot of Democrats with bad sentiment just because Donald Trump is president. Because it works both ways, by the way. The red cult can be a hypocrite and now say this is the best economy ever and the stock market is the greatest ever. And the blue cult would say, the economy is the shittiest ever and everything is going to collapse right now. So you have to look at independence. And the problem is when you look at the consumer sentiment by party, sure, the Democrats, the sentiment is collapsing. Got it. But so are the independents now. Their sentiment is crashing down too. And even the Republicans beginning to change their opinion a little bit. So this doesn't look good. And folks, we said before that if the consumer begins to sound sour on the economy. The psychology becomes a self-fulfilling prophecy because they're going to stop spending, reduce spending, save more, and that's recessionary behavior. And all in all, the question in the survey is, do you favor or oppose placing tariffs on goods imported from other countries? Look at the change here. In favor is down 6% since the last survey. That was in Jan 2025. In April, the percentage of folks who say they're in favor of tariffs is going down. Meanwhile, the percentage of folks who say oppose jumped higher by 8 points. And this is, of course, when folks see the reality of the damage of the tariff. You can support it in principle that, oh, we got robbed and we're just neutralizing the game. We're going to have a fair deal here. That's all we're looking for. Maybe we'll bring back some manufacturing jobs. Sure, all of that is good talk. But once you feel the pain, you're going to begin to change your opinion. And we have worrisome signs here, folks. On Friday, an important company, Fastenal, a lot of screws and bolts and tools coming from Taiwan now being tariffed. Fastenal says that we're going to raise the prices higher. If we have to deal with tariffs, we're going to raise the price higher. And further hikes could happen. We're going to pass everything down to the consumer and then some. And of course, the stock market loved it. It was a huge rally for Fastenal. Because now it's going to be a game of which company can pass the extra cost from the tariff to the end consumer. Those are going to be winners. The ones who can't are going to be losers. So the damage in the economy is already happening. And when we look at, once again, CPI, sure, the reading on Friday came down, but that's lagging right now. That's before the tariff fiasco. So if you look at the October 2024 forecast, they were expecting that inflation CPI would be below 2.5, between 2 and 2.5 in the next few years, which is acceptable enough for the Fed. In Jan 25, that forecast went a little higher, above 2.5%. In the month of April 25, with the tariffs now in full force, the expectations that inflation is going to move up to over 3.5% as soon as this year. Now, not all of the impact that we see in the economy is negative. Of course, increasing inflation, increasing recession odds, that's awful, but there are winners from all of this. For example, if you have a luxury car dealership, those are flying like hotcakes. I got a friend who owns a Porsche dealership in California, and they've been saying those 911s are flying like hotcakes. Because if you want them, you get them right now. Otherwise, the next batch will be an extra 25%. And that's the minimum, of course. So some companies will benefit as the consumer begins to front load the spending and buy stuff ahead of time before the tariffs kick in. But not all companies are going to survive. The headline reads, Trump's ongoing 25% tariff expected to cut sales by millions and cost $100 billion. So that's not exempt. We're going to have 25% tariff on all foreign vehicles. And if you can't pass the extra cost to the end consumer, or you can't front load demand as Porsche did, for example, they're still going to lose in the long run because cars are going to be super expensive after they run out of the inventory that they got already. But you have dealerships like Mercedes-Benz, for example. They're saying we're going to eat the tariff. We're going to incur the cost of the tariff so we don't have to pass it down to the consumer. Well, that means reduction of profit margins. And I'm giving you just an example from the auto industry. It's going to be applicable in many industries in the economy. Those companies who can pass the extra cost from the tariff down to the consumer, or at least front load some demand, they're going to do pretty good. At least when we talk about this earnings season, we'll begin to hear some good news, even though the quarter is already done, but they're going to give it in the guidance. So, hey, we've seen increasing the demand all of a sudden, because folks are afraid of the tariffs. But if you happen to be a company when you can't front load demand and you can't really pass it down all the way to the end consumer, it's going to be ugly, ugly, ugly. And we have a lot of confusion here, folks, because over the weekend, a lot of customers at the Apple store, they all want to front load the demand and buy some iPhones before the tariff is implemented, because the iPhone is going to cost almost double. So might as well buy it right now if you wanted it. The problem is we got the headline that the Trump administration is exempting iPhones from the tariffs, at least for now. So you got to feel sorry for folks who went to the store, panicked, and they bought an iPhone even though they don't really need it because it's not subject to the tariffs anymore. Or is it? You saw the intro of the video with Secretary Lunatic now saying, oh, we're gonna tariff the chips and the computers and the iPhones, but that's going to be a separate bill. That's going to be after an investigation. So that's going to cause a lot of confusion. And the problem is, we talked about the weakness, right? The weakness that was projected ahead of time before the battle even began, with the capitulation and extending the deadline for Canada and Mexico. That projected the weakness for all of these countries not to come to the negotiation table, and even escalate in the case of China, because they knew if the market goes down, he's going to backpedal and flip-flop. If that kind of mentality spreads to the consumer, where the consumer says, you know what, I don't need to front load iPhones right now. I don't need to rush or panic in buying anything because of the upcoming tariffs, because he's not going to implement it. He's going to flip flop. So I'm not going to spend right now. If that begins to spread, if that kind of thinking begins to spread, it's going to be bad for the economy. I mean, bad for the only argument you can make, positive argument that you can make from the tariffs to the economy, which is front loading some demand and maybe passing the extra cost down to the consumer for the companies who can afford to do that. Furthermore, when we talk about the damages done when it comes to the inflation front, we still haven't heard about the pharmaceutical tariffs. The president says we have major pharmaceutical tariffs. And again, you can make an argument that this is a national security issue or whatever, so we need to bring back big pharma manufacturing here. Sure, teach his own, but the tariffs will cause costs for pharmaceuticals to go higher. That's the reality. That's inflationary. And along with the inflation threat, we still have the recession threat. You can see here the probability of a recession hitting the U.S. in the next 12 months. It's almost 50% right now. JP Morgan says 60%. You look at inflation-adjusted consumer spending, already got a peak and now heading down. With the consumer not spending, that's going to be bad. That's recession in the economy. We talk about many indicators. You got the lipstick indicator, the underwear indicator. You got the Hoe Indicator, which we're going to visit in a minute. But you also have the beauty salon, aka the blonde indicator. And it's flashing red right now. What is the beauty salon indicator in a nutshell? It costs a lot to do your hair. I mean, what is it? $300, $500 these days? That's a lot of money. So what happens is the ladies, they're going to stop dyeing their hair blonde because it costs more. So if you notice less blondes, if you see the disappearance of blondes in the economy, you know that's bad. And folks, here's perhaps the most accurate recession indicator, a segment we call the Hoe Indicator. And as we said in the previous video that the Hoe Indicator is flashing red, we get more and more troublesome signs. The headline reads, sex workers have been saying a recession is coming, and their financial indicators are eerily spot on. What are they talking about? Here it is. According to Denior, this is what they call a madam, right? Business at her brothel usually picks up in the spring once people give up on their New Year's resolutions and recover from holiday spending, but this year business is down. She attributes the huge dip. That's not a dip you want to buy unless you want herpes. But anyways, she says attributes the huge dip in earnings at her brothel to customers feeling insecure about the economy. There are significantly fewer clients coming in, and the sex workers are reporting noticeably lower earnings. Although Denoyer emphasizes that the top sex worker at her brothel is still earning more compared to the general population. That's a shame, isn't it? We are in an economy where a hoe's making more than an engineer. If that's not a sign of a bubble, I don't know what it is. But anyhow, she said some of the highest earners at her brothel are earning about half of what they did during the same time last year. That's flashing red. What about the strip club? Well, here it is. Strippers in the U.S. are also feeling the pinch. Dancer and influencer Vulgar Vanity said that when she first started dancing in 22, she could earn six figures just by dancing during a handful of big events in Austin, such as the Formula One and the South by Southwest Music Festival. This year, it is different. She says, I didn't even bother working South by Southwest because the first Friday night I attempted to work, I walked into a completely empty strip club and didn't make any money at all. Once again, sound the alarm. I'd love to see one of these reporters asking Scott Bessent about the Hoe Indicator. Hey, what do you think about the Hoe Indicator? Flashing red. In all of these problems, folks, when you have uncertainty in the economy, when you have chaos, and you have consumers now becoming sour on the economy, do you think that U.S. companies will continue to spend like a drunken sailor? Because as we've said repeatedly in this show, that we are probably in a recession since 22. But the only thing that masked the recession so far is the fact that we have the affluent consumer, because the manipulation of the stock market, and the AI bubble, where we have these giant companies who can continue to spend B2B billions and billions and billions of dollars. And so long as they do so, the stock market goes up and stays up, and the affluent consumer can drive over 50% of the consumption in the economy. So we avoid a recession. The moment the big cap companies, the technology companies begin to reduce spending, that's going to be disastrous because it's going to pop the AI bubble. And if that happens, we see the market going down again. Forget about the tariffs. Now it's about the end of the AI bubble for now, reducing the confidence by the affluent consumer, and no more Porsche 911s for you. And the bottom line is, don't get too excited about these rebounds and rallies that we see in the market. We are not out of the woods. And to add to this conversation, let's talk about the market a little bit by revisiting our trading and investing strategy. Now, I gave you my own Hoe Indicator throughout the week, specifically after the rebound that we got. And I said that the Hoes right now is saying that this is a dead cat bounce. And if that is the case, then we're probably going to rebound more. We're not through with the rebound. And I think that's going to play out, folks. Spent the whole weekend doing my economic research at the strip club and with Hoes. That cost a lot of money, folks. So please go to the links in the description and become a Maverick member either here on YouTube or Patreon so you can support my economic research. That way you don't have to go down to the strip club yourself and then get caught by your wife. I'll do it for you. I'll take care of you. But anyhow, folks, the tragedy is, of course, without a strategy, it's going to be a tragedy in your portfolio. Look no further than the retail investor. Retail investor have been buying the dip over and over and over and over again as the market continued to go down and down and down. When the retail investor finally decided to go with put options and flip their bets from bullish to bearish, here comes Scott Bessent with pumping the market higher. So you need to have a strategy. And let's revisit last week's strategy. I said close April expiration puts, book the profits, and keep May's expiration puts. This was a good strategy because we had swings. Yeah, we had a big swing up, but we also had swings down. And the volatility index is still above 30, so you still need some put exposure, but you can reduce the cost and maybe raise some cash by number 2. Prepare to sell covered puts on your short positions this week. And again, if you sold them earlier in the week, and now we got the rebound, you cashed some of the covered puts money. Number 3, we said speculate on a rebound via put credit spreads 2 weeks out in shorter dated weekly calls. Once again, they paid off once we got the big rebound, the Bessent rebound. Number 4, in the event of a rebound, book gains quickly and begin to double down on open shorts for May and beyond. That's going to be adjusted a little bit because we have a shorter trading week. We have a lot of capitulation that happened over the weekend, a lot of conflicting opinions, and maybe this is going to happen, that's going to happen. So it could be actually a good week for the market from 2 perspectives alone. The shorter traded week, and number 2, that at least the news is not going to get worse unless we tariff China 400%, for example. Absent of that, no more escalation in the trade war. We can continue to rebound higher despite the bad news, which means that a lot of traders, and I said that throughout the week after the rebound, traders who think that the market may be overbought and they want to wait for a dip or they think it's going to go down again. You got to be careful here because what's overbought can become even more overbought. It's the same thing that we said when the market was going down. Don't say that you shouldn't short right now or you're just going to wait for a rebound before you short, because what's oversold can get even more oversold. This is the bear market dynamics. The downside is huge and fast, but so are the rebounds. The rebounds are big too. So what is the strategy for this week, Mav? Let's go back to the morning brief from the 11th. This is Friday, and then I'm going to show you my strategy. In my morning brief, I said today's reason to be bullish, the HYG. In a nutshell, I said if it trades above 76 and keeps 76 as support, that's going to be a bullish sign that at least we are reducing the credit risk in the market right now. Gave you this chart right here. That maybe the HYG is forming an inverse head and shoulder pattern. And so long as it keeps 76 as support, you gotta think that the rebound has the upper hand in the market. Well, here's the update for you. HYG retested 76 and then bounced and closed pretty much at the highs of the day. So that support has been protected for now. That's a bullish sign. I said today's reason to be bearish, the VIX and the US 10-year yield. In a nutshell, I said in the 2 years VIX chart, you can look at the MACD indicator. It looks as we might have the probability of the MACD shifting back to bullish. And under that circumstance, it means that the VIX will move higher. But once it cracks 58, that means that we have another explosion in the VIX and another leg down in the market. Here's the update for you. The VIX did not shift and actually formed a bear flag pattern. So the reason to be bearish on Friday got weaker. Another reason was this guy right here, the 10-year yield, 2 hours chart. This is what I gave you in the morning. It looks like a cup and handle. And here's the update for you. It did play out, but also reversed via a bearish engulfing candle and now forming a bear flag pattern. If that continues to hold, then that's less reason to be bearish. Confirmation number, light crude oil futures 58.76. This is what I said. If we lose that number, then recession fear is back on the table again. And we're going to see credit risk, HYG heading down, and the market will head down with it. This is the 2 hours chart of the crude oil futures right now at the time of the recording of this video. We have defended 58.76 in Friday's session, and so far so good. crude oil is forming an inverse head and shoulder pattern in the 2 hours chart. So with all of that, here's the concluding brief that I gave you on my Discord on Friday. Number one, by China retaliating, but announcing that they won't retaliate to any further action by the Trump administration. The market gets the picture of a ceiling in the escalation. And the next step under the market's assumption is negotiation. The market is beginning to look at it from the glass half full side, which should support the index to rebound next week. And I know what you're going to say, but Mav, what about the flip-flop, about the semiconductor and the iPhone tariff? Well, think about it this way. As we were closing the market on Friday, the market was already looking for the glass half full. That, okay, it got really, really ugly, but it's not going to get uglier. So I'm going to have that as optimism. Now, whether we're going to have the tariff removed and exempt altogether, of course, that's the most bullish scenario for the market because you'll see massive short covering in Apple and in Nvidia. Two stocks alone that could push the indices significantly higher. But even if it is a delay, and we're going to get them later, according to Secretary Lunatic and Pete Navarro, even if that is the case, that is still better than what we assumed on Friday, that iPhones, electronics, and semiconductors are not exempt from the China tariffs. Now at least we got a delay, so I think it's a win-win for the market, even though it's a smaller win. Anyways, we go back to the concluding brief. Number two, the 2 hours chart of the VIX. We talked about this. It failed to shift momentum from bearish to bullish, now forming a bear flag pattern. We talked at number three, the HYG retested 76 and defended it. Number four, the SPY hourly chart is showing a cup and handle pattern. We can retest the previous rejection at 546.34, or even close the gap at 564.66. Therefore, I would concentrate on building some rebound plays for next week and add to existing ones. At the same time, only puts with the expiration date in May and beyond, with no more than minus 10%, the break-even should remain. And here's the chart that I gave you. The 2 hours chart of the SPY looks to me like a cup and handle. There's a possibility that we could trade positive this week. So this is the main trade that I've done. This is the bullish trade, the rebound trade. It's the SPY 560 calls. We bought that on the 9th. The expiration date is the 17th. We paid about $1.85 a piece for those. At the same time, because volatility was increasing higher on the calls side, that was the Besant reversal day. I decided to sell the 565 diagonal with the expiration date of last Friday, and I was able to raise $1.10 a piece from those. We closed below 565, so this was a win for the seller, aka me, not so much for the buyer. So I get to net the entirety of the credit, 110. On Friday, I decided to open the 565 debit spread on the 560 that I got with the expiration date of this upcoming week. And I netted about 66 cents a piece. Could have netted more had I waited, but I wanted to get the note for you because we got only 5 minutes before the close. All in all, the entry cost for the 560 naked for the 17th was 185. We shaved off 110 out of that by selling the diagonal, 565. And then we raised 66 cents from opening the debit spread at 565, same expiration date, the 17th. So the total entry cost for this trade is only 9 cents a piece. So I get to play here. If there's a massive rebound, I get to play with 9 cents. And frankly, if you average down in this trade when the market went down after the Besant rebound, you probably got paid for the trade right now. So that's going to be the main bullish trade. What is the main bearish trade for now? It is the SPY 500 puts. The expiration date is May 16th. And of course, when the market went higher, that's going to be reduced in value. So we sold the 510 puts with the expiration date of the 17th, assuming we don't go below 510 by Thursday of this week, netting a credit of $5. But you got to remember, we still have the 500 puts all the way to the 16th. If the market decides to go down below 510 in the following week, we still got that trade and that exposure to the downside. If I see more evidence that the trade war is cooling off a little bit and the market at least treating it that way, what would be my indicator? The dollar. We'll look at that in a minute. But if I see the dollar going higher, what I'm going to do here is maybe buy some puts on the GDX gold miners, because money's going to come out of gold to chase equities under the bullish/rebound scenario. So you see this trade right here. The trader bought the 43 and the 45 puts for different expiration dates in 27. I'm not going to go to 27. I'm going to go maybe with the weekly or the bi-weekly expiration. But the point being is maybe the GDX is way overbought right now. It's going to move down. If we see the dollar rebounding, and that's going to be based on the optimism that, okay, we have reached right now the ceiling of the trade war and the escalation. If that is the case, then maybe you want to buy rebounds in China, maybe the EEM, because we had a really big, unusual activity here. It's for the expiration date of 2026, so we're not going to go that far, but we'll go something near, weekly, bi-weekly, maybe monthly, and buy some calls on any Chinese ETF like the FXI or KWEB or maybe the EEM, the Emerging Market ETF, where Chinese equities have the lion's share of the weight. But again, before you do that, we're going to look at the charts for confirmations. We begin with the E-mini futures and the S&P 500. This is the weekly chart. We defended 5,000 for now. We closed above 5,300, which is a really important support. You don't want to lose that, so long as we trade above 5,300. The market rebound still has the upper hand. How far can we go in a rebound? We can go as far as the 50 weeks moving average. That's going to be a little above 5,800. Really that big? Yeah, it could happen. Bear market rallies are big. It could happen in the most bullish scenario, but you got to watch out for that 5,300. If we begin to lose that before or after touching the 50, doesn't matter. If we lose 5,300, then now the downside gains the better odds versus the rebound. And you got to flip your bets. You got to concentrate more on building short positions, not rebound positions. Maybe you want to exit some of the rebound positions that you got. Likewise, in the NASDAQ futures, I can see a retest all the way to 20,000 at least. And so long as we retest 20,000 and we trade above and we're not trading below 18,000, the market rebound has the upper hand. But if we go down, we lose 18,000. You got to shift. We have more downside to come. The dollar, of course, is going to be your leading indicator, the Dixie daily chart. We need to see the dollar rebounding. So long as the dollar continues to crash, then foreign investors are dumping the US dollar, and that's going to cause more and more credit risk and more volatility in the US equities market. Volatility meaning that we're going to go down again. So we need to see the dollar index rebounding. And maybe it looks ugly right now, but we're going to see a rebound, an oversold rebound at least, overnight. Because if you look at the major charts, the main components of the S&P and the NASDAQ, you take, for example, Apple, the 2 hours chart. It looks pretty good right now. It looks as an inverse head and shoulder. You look at NVIDIA's 2 hours chart, it looks like a cup and handle. Unless it loses 106.5, it looks pretty good. You look at Tesla, even Tesla, the souffle 2 hours chart, is forming an inverse head and shoulder pattern. So right now, we're going to enter Monday's session with the assumption that the rebound has the upper hand until proven otherwise. And now you know what level you need to look at, 5,300 in the E-mini futures. You go below that, you got to shift the assumption. With that, folks, let's move on to the conclusion of this video. What do we have on the economic calendar this week? Monday the 14th, we have the Philly Fed Zombie Harker and Atlanta Fed Zombie Insider Trader Bostic speaking, so not an important day and a really nice day to do a rebound with the absence of macro data, hopefully if we don't see any tariff escalation. Now, Tuesday the 15th, we have the Import Price Index. This is going to be really important because it is a pulse on inflation because of tariff. And likewise, we have the Empire State Manufacturing Survey. We know it's been weak, but what about the price index? Are they expecting higher prices to come? And then we got the 16th, Wednesday. The most important piece of data for the week is retail sales, because it could go either way. It could go up if the consumer is front-loading before tariffs. If the consumer right now is buying vehicles and buying furniture and buying appliances before the tariffs kick in, that's going to be a net positive for the economy, at least right now, and the market might love it. On the other hand, if we see the doom and gloom psychology, the recession psychology, taking over the consumer spending habits, if that comes out, then it's going to be ugly because it will show that even with the tariff, we're not seeing the consumer front-loading. The consumer is waiting because maybe they can't spend anymore. They'd rather save than buy a fridge or a car or an iPhone. So once again, retail sales is going to be the most important piece of data this week. But we have also Wednesday the 16th, we have the industrial production capacity utilization, business inventories, along with home builders confidence index. So we have another Fed zombie from Cleveland talking. Thursday the 17th, we get initial jobless claims on top of housing starts and building permits, concluding with the Philadelphia Fed Manufacturing Survey. Now, Good Friday the 18th, we're going to be off. No trading, the market is going to be off. But we still have one Fed zombie from San Francisco Daily speaking. Take a break already, it's Easter. You're not going to add anything positive to the conversation. You guys caught with your pants down, and now you're shocked, dazed, and confused. And you have no idea how to deal with it. I'm talking about the Fed, of course. But with that, folks, I hope you found the program and the coverage that we've done today informative and helpful. And if it did, return the favor by pressing the like button, subscribing to the channel, leaving us a comment in the section below, participate in the conversation. If you disagree, let me know your opinion. What do you think? Why? Enlighten me. If you agree, let me know. And better yet, folks, consider joining us as a Maverick member so you can watch the daily show and not miss out on the action and the guidance that we're giving on Discord and the streams and otherwise. You can find the links in the description and join us on YouTube or on Patreon. But once again, folks, with that, this is all I got for you for tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
So, what you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.